All right. Welcome to the Michael Does Mortgage podcast. How's everybody doing today? I'm Michael Seaver with Intercap Lending, and today we have Paul Scalone with Dignified Insurance Services. How you doing, Paul?
I'm good. How are you, Michael?
Oh, it's fantastic. It's a Tuesday. You know, what else do you do on a Tuesday?
Work. That's usually what I'm doing on any day that ends in
I'm
Y.
allergic to four-letter words that begin with W and sound like work.
That's fine.
Yeah. But anyway, before we get started, I'd like to ask you a couple just fun questions.
Okay.
All right. Have you ever played the game Would You Rather?
Probably.
Okay. My kids ask me this all the time. I get a little annoyed. I'm like, I'm done here. But nonetheless, here we go. So the first one, would you rather have the ability to see the future or go back and correct or change your past?
That's a loaded question.
I know.
Because I love who I am. I love me. I mean, most people do, right? But seeing the future, I don't know. Yeah, I'd go with seeing the future because then I'd be able to make more money in the present. So we'll go with that. The only drawback is I know when I die, and that sucks. But, maybe I could try to avoid it. But, that's only a matter of time.
For sure.
Yeah.
I think I would rather see the future too, because I think, I've made mistakes in the past, but that helps develop the character, right? And I've made it this far. I'm doing okay. We're alive. I got 2 great kids, all that. I think seeing the future would be my choice on that too, but it's the same.
Right. Way
I
more
would know
depressing.
when it's coming,
Right.
and that might be terrifying.
Yeah, for everybody, not just yourself. But,
Right.
Anyways.
Like, hey guys, tomorrow's my last day.
Yeah. So it's been real.
All right, next one.
Okay.
So I'm single, dating. Yeah, right. You were in a fantastic relationship, but remember your first date? So my question would be, would you rather be gassy on your first date or have a tooth fall out during your first kiss?
That's a good question. I'd rather be gassy because my parents paid a lot of money for these teeth. So, I don't want them falling out, especially in someone else's mouth. Hashtag awkward.
I'm 100% with you on that one. That would be so embarrassing. Like, you couldn't come back from that.
I mean, you could, but would you want to?
She must be desperate.
Would you want to?
I mean, gassy, everybody gets it every once in a while. You can kind of whatever, but like a tooth falling out in their mouth.
I guess it depends on what tooth. Like, is it like in the back or is it like, my front one?
I don't know if it matters on that.
Right. Yeah. Yeah, I'm going to go with gassy for 100, Michael.
Oh, all right. Well, Paul, tell us about Paul Scalone and Dignified Insurance Services.
Yeah. So like Michael said, I'm Paul Scalone, better known as Better Call Paul, for all of your insurance needs. So Dignified Insurance Services started back in May 2023 and was a product of working in the insurance industry for the past 4 years or so now. For Allstate in particular, there were some changes that happened over at the office I was working at. A guy sold his book to another Allstate agent and yada, yada, yada. Long story short, I probably should have been out of there, 2 years ago, but with COVID and everything and just, uncertainty and making that leap and how's it going to work and whatnot, I never did until I was kind of, looking at what my path forward looks like. And the whole idea has always been to open my own independent insurance brokerage, get out from underneath, Allstate, all that stuff. And the time was just right. So I stepped out and opened Dignified. We've been in business, like I said, since May, just continuing to grow every month. And honestly, it couldn't have been a worse time to open an independent insurance brokerage in California, or probably any business for that matter. But, sometimes the best laid plans, they just, it doesn't matter what your plan is. The universe kind of tells you this is what you're doing. And you go forward and you make it happen. And that's where we're at right now, just making it happen every day.
So 4 years in insurance world, property and casualty, or what else do you do?
So I'm licensed property casualty. That is my wheelhouse, my bread and butter. It's what I know. Home, auto, commercial, liability, umbrella, all of that. I'm licensed to sell life and health. I don't sell health insurance. I got a guy though, because if you call Paul, Paul's got to be able to call somebody. For health insurance, I got a guy. Because that's its own separate beast entirety. I just have to just do that, So, like I said, licensed life as well. I will sell some life insurance here and there, but it's really not a focus of mine. my bread and butter, my main focus is the property casualty, the homeowner's insurance.
Awesome.
Yeah.
So 4 years, what did you do before?
Before insurance, I worked in healthcare. I worked in healthcare for 15 years. I started as a warehouse clerk for a small medical group up in Poway. They were independent, owned by about 12 doctors that broke away from Scripps. Back in the day, worked there, worked my way up the corporate ladder. When I left, I was their director of supply chain management, oversaw their acquisitions, supply chain facilities, contracts, all of that. And had an opportunity to just really transition out of that entire space. I'd been there for 10 years and into an operations role doing home-based healthcare. Spent about 5 years in that space doing non-medical home care, doing hospice, home health from an administrative standpoint. So I ran the companies, I started companies, I ran sales teams for, hospice, home health, all of that. And I worked for some small startups. Like I said, people that hired me to come in and build this non-medical private nursing, from scratch, all the way up to the last position I held was with the third largest hospice provider in the United States. And looking at it, they're all contending with the same issues, the same problems, the same challenges. And a light bulb kind of went off. It's like, oh, this is never going to change. This is just your life now, Paul. So you either, buck up and, just agree that this is what your life's going to be, or you make, some decisions on where you want to go, what you want to do.
Gotcha. And so insurance was birthed.
I was like, hey, I've never known a poor insurance agent. So I answered an ad for an outside business development rep for Allstate and officially became the first poor insurance agent. It's been great.
That's great.
It's great.
Well, I've had the pleasure of knowing you for about those 4 years, I'm pretty sure. And you've been a rock star for me.
Thank you.
In a lot of different aspects, especially on the lending side for me, and give my clients the quotes they need and in a timely manner, which actually leads me into the topic today. What in the world is going on with California homeowners insurance right now?
That's the $1 million question.
Right. I'm hearing all kinds of things. We're experiencing things on our end, on the lending side. We're sending our clients to get quotes, when they're buying a new home. And we used to have, what I hear, and you can elaborate on this, like there used to be like 120 or so carriers, and now we're down to like 4 or 6 or something like that. And so, like, what are we experiencing here? What's going on in that? And there's delays. There's all kinds of things going on.
Right. So what we're experiencing is a extreme contraction in the insurance space in California. The reason for it being it's a compound effect between the natural disasters that we've been having, through wildfires in Northern and Southern California. This isn't just isolated to, Southern California or San Diego fires or Northern California, those fires they've been having up there. This is a California-based situation that we're facing. And the problem has been compounded with the rise of COVID. And with that, we all saw, disruption in the supply chain for everything, right? Everything. We had some temporary supply shortages that drove up prices. They've been kind of relieved. But also now, if we're looking at this from an entire standpoint, if you look at, for instance, the cost in which it takes to work on a car, right? So I had a friend recently just had a minor fender bender, bumped into one of those little yellow poles in a parking lot, right? It's like, okay, she drives a Mercedes, nothing like super like crazy, but also not like a Pinto either, right?
Right.
So she takes it in to get the yeah, taking you back there.
Okay.
You know.
1979.
Yeah, exactly. So she takes it in to get kind of a quote on what it's going to cost to repair this, that, and the other thing. And quotes came back between $7,500 and $12,000. And this is going to be an insurance claim now. So now this is just one instance for one person, right? And you're talking like a minor fender bender costing, upwards $7,500 that the insurance company is going to have to pay. And this is just for auto. Now think of, the cost of reconstruction, the cost of materials, the cost of labor, the cost of everything has just gone up exponentially, okay? So you combine that with laws that California Department of Insurance has on the books that say insurance carriers are not allowed to just raise their rates willy-nilly, right? Which is good practice in theory.
So they have tolerances, basically?
They have a process.
Okay.
If an insurance carrier wants to increase their rates, what they have to do is they have to go to the Department of Insurance and essentially create a statement on why they want the rate increase that they want and be able to back that up with data. And the data that they use has to be historical data. So they can only use data based on events that have already happened, losses that have already happened, costs that have already happened, right? In the past. They're not allowed to use any future modeling for any of these price increase requests.
Okay.
So you combine a industry that is a for-profit industry, right? Doing business in the state of California. You have the cost of everything going up, tenfold over the course of 3 years, right?
Yeah. Inflation, baby.
Right? And you can't, as an insurance carrier, you can't keep up with that cost, right? So, and this is a number that's been kicked around. I've heard it multiple places. I believe when I left Allstate, they were losing, for every dollar in premium that they wrote, they were paying out $1.12 in claims.
Oh,
now,
so that's going backwards.
That's going backwards. I'm no mathematician, but I do real estate math, and I can tell you that that's not a sustainable business model.
No.
So it's no surprise that these carriers have been trying to get the Department of Insurance to listen, to come to the table, to have these conversations, and Department of Insurance has taken the position of, we're here to protect the consumer. No, 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 no. So now what we've been seeing is carriers are like, fine, we're not doing business in California anymore. Figure it out.
So now that's leading to a big problem, right?
Yes.
So now we have the quotes are taking longer to get back because now you got in a sense, the same amount of people now bombarding the few that are left to get quotes.
Arguably more with the amount of people that are moving into California.
Right. And now what we've seen come back is almost doubling what they used to be for their new policy quote. Mm-hmm. Maybe not in every case, but they're substantially more, enough that it's made me change how I qualify a borrower or buyer to go out and get pre-approved. The number I used to use is no longer usable, right? It's substantially more. It's not quite double, but it's close. For instance, on a condo, I used to use about $75 average. Came out to about $900 a year. That would usually cover most condo policies, right? Now we're at about $120. $120 a month, right? Yeah. So we're getting up into the $1,500 a year.
That's back what homeowners policies used to cost.
Right, right.
Like 2018.
Homeowners paying the price of the house. I'm at 150, maybe even higher, just depending.
Right.
And then we're waiting. We're twiddling our thumbs, waiting to get that back once they go under contract, so we can send it into underwriting.
Yep.
So now we've got this problem. Do you see a light at the end of the tunnel for this?
Yes and no. Just like anything in insurance, there's no one straight answer, right?
Well, let's take the yes side. What do you see is going to change, that's going to improve and all that?
The yes side is back in the end of September, Department of Insurance and the carriers finally went to the table, had a conversation, and came to an agreement. It's something that's been being pushed for quite some time, and we're happy to see that actually happen. So what does that mean? What that means is the Department of Insurance has agreed to change some of the rules of engagement for the carriers. What they're going to do is allow the carriers to start using projection modeling for when they're requesting their price increases.
Okay. So now they can base it on what could be coming down the road.
Correct. Okay. Exactly. So that was a big thing that the carriers wanted to see. The other thing that the Department of Insurance agreed to is allowing the carriers to pass off some of the California reinsurance costs to the consumer.
Okay.
Okay.
Explain what reinsurance is to our listeners.
So reinsurance is a complicated, super fun insurance thing that will put everybody to sleep with. But the long and short of it is these carriers, like Farmers, any big carrier is going to take on a certain amount of risk, right? Let's say they have a $2 billion book of business.
Right.
So they're on the hook for $2 billion. Let's say every property asset that they insured went up, they'd have to pay out $2 billion.
Right.
So what they'll do is they'll take that risk and take it to the open market, and there's companies, organizations that will buy some of that risk. So they'll buy it, and that way it's essentially kind of pooling the risk out, so no one person company is on the hook for all of it. And that's the quick and dirty of reinsurance.
Great. So now that we've talked about the yes side is going to improve. What is not going to get better?
What's not going to get better is everything's going to continue to increase as far as prices go. So I think it's important to back up a little bit. The deal was the Department of Insurance is going to allow the carriers to use projection modeling and pass off some of the reinsurance costs. Okay. So in exchange, what the Department of Insurance is expecting from these carriers is they're going to come back into California and they have to insure homes, properties that are in high fire risk zones up to the tune of 80% of their market share. Okay. So that's a trade-off there. So what's going to happen is it's going to bring more carriers back into the marketplace. And we know historically, if we have more competition in the marketplace, typically the consumer has more options, which drives prices down or at least level them out. Okay. So, which is good. But with what we're seeing in the space right now is I think 5 or 6 of the largest carriers all have applications in right now to have their rates increased. And that percentage, I looked at it, average percent's like anywhere between 37% increases. So I think it's important for everybody out there to understand that rate increases are coming to a insurance policy near you. So don't be shocked, be prepared for it.
And this is for existing rates too.
This is for existing rates.
Okay.
Yes.
So you said something, 80% of their loans now have to be fire, right? Something like that?
So 80% of their market share has to be within high fire risk zones.
High fire risk zones. Okay. Yes. So the question I want to ask, do you think that's going to like redraw what the fire zones currently are? Are they going to, because if they're going to take on 80% of this market share, I feel like, and maybe I'm wrong, like if you even can see a brush area, you're going to be in a fire zone.
Right. So the fire zones are the fire zones. How those lines are calculated, I don't know. And what I do know is each carrier has a different methodology in which they use to calculate fire lines and what's considered a high fire risk zone. Okay. I feel like, and this is just pure speculation on my behalf, I feel like the Department of Insurance is going to have the final say on what they're considering to be a high fire zone, especially with this deal in place. Okay. I can't imagine a time or place where the Department of Insurance doesn't have some sort of input on what's considered a high fire zone. Yeah.
For sure. So now we're not only going to be affecting homeowners insurance policies, but now when you get into situations like condos that have a master HOA insurance policy, that's going to increase too. So that's going to be, obviously we know, passed downhill.
Correct.
To us that live there and pay the HOA. So now our HOA fees are going to go up.
Right.
So how much, I know it's hard, there's no crystal ball, but what do you see, what do you think the increase is going to be there? Earlier you said about 32%. Is that?
That's rate increases that carriers have to the Department of Insurance.
Okay.
And that's average, right? Some of them are asking for 12%, some of them are asking for 18, some are asking for 35, right? But if we take those top 5 carriers, look at their rate increase request, average them out, we're coming in at about 32%.
Okay. Yeah. So that's going to be on your personal policy and your HOA's policy, which is going to come through to as your HOA dues.
Right.
So,
correct.
Okay. Well, the other question I've heard, once I've had clients that, they're set up, they buy a house, they got their insurance, we're 2 years down the road, they get a claim, which puts us in today's time with all this going on. And I've heard some horror stories, maybe they're true, maybe they're not, about just they went to file a claim, they ended up just getting canceled because of all this going on. They just, it almost seemed like they were looking for a reason just to get out of the policy, the carrier at this point. Are you seeing any of that? Is that something that should be expected?
Good question.
Can you talk about that?
Yeah, absolutely. So as far as claims are concerned, I don't have any personal experience with somebody filing a claim and then the carrier dropping them. I'm almost certain that there's laws on the books that insurance carriers aren't allowed to drop a person because they filed a claim, right? Now, there are rules like the amount of claims that person has. It might not be on that property. Maybe they owned a property or a rental before. They had 2 claims, right? They purchased a property. Now they have a claim. Now the carrier might have grounds for like, hey, we're going to go ahead and process this claim. We're going to get everything fixed up, this, that, and the other thing. But also what's going to happen is when that policy term expires and it comes time to renew, the carrier is going to be like, yeah, we're not going to renew you, right? Good luck. You're going to have to go somewhere else because they don't want to assume the risk.
Right.
So as far as a claim standpoint goes, I haven't seen a lot of people being dropped for claims. I have been seeing properties are harder to insure or get carriers to agree to take them in the first place if the property or the owner of that property or the buyer have claims history. Right? Because also what we're seeing, because the market is contracting so hard, and you probably see this, in the lending world, the underwriting guidelines have gotten real tight.
Yes.
Right? So they're looking at everything with a fine-tooth comb. They want to make damn sure that if they're going to take this risk, it's as close to a sure thing as they can, right?
Right.
Because insurance carriers, they want a sure thing all the
It's
time.
risk mitigation.
Yeah. Let's, dude, the house was just built yesterday, and it's like in the middle of San Diego. Dude, we will take it all day long.
All day long.
Right? Yeah,
right.
for sure.
No pool.
Right. Fenced, everything, security, cameras,
Yeah.
sensors. Yeah, please. We'll take that. And we'll give you a pretty good rate too, So I've been seeing them get a lot tighter on the underwriting guidelines. The other thing that I've been seeing is people who have had properties insured for years, right? I actually just got a phone call yesterday. This guy lives over in Mission Hills. He bought his house probably brand new in like 1964, right? He maybe even built it, I don't know. But he's been with Farmers for that whole entire time. And this year, his policy goes to renew. Farmers comes out, they do an inspection. They're like, hey, you got too many trees, this, that, and the other thing. You need to chop all this stuff back. And if you don't do this, we're not going to renew you. He goes through, he does all the work. Farmers comes back with a drone, shoots some video footage. They're like, the trees still aren't good enough. You need to continue to do this or else we're not going to renew you. So the moral of that story is the carriers, they're not going to come in because they're not allowed to just come in and flat drop people. So they're looking at people whose policy terms are up in areas that they feel are a higher risk. And they'll come in and they'll look and say, okay, well, you need to do XYZ amount of work or else we're not going to renew you, right?
Right.
And I had somebody that lived out Los Coaches, East County with Allstate for years. Same thing. They wanted her to do probably $60,000 worth of work to her house if they're going to renew her.
Woo.
Yeah. So she came to me. It's like, Paul, what do I do? And we took a look at it and had to get her into a California Fair Plan with a difference in condition and all of that. It wound up being a little bit more expensive than what she was paying, but she's still insured, which is important, right?
Better than the 60 grand.
Yeah,
right.
Exactly.
So you mentioned California Fair Plan, which used to be a lot of fire coverage, right?
Yes.
How's that working with the new thing that's coming and these carriers having to have 80% of that market space?
Right. So that's a great question. So the California Fair Plan has existed to insure homes that traditional insurers won't insure because of a higher fire risk.
Right.
Literally, the Fair Plan protects you for fire, smoke, those things.
Right.
So what's been happening now is because of these carriers leaving the marketplace, California Fair Plan has been inundated with applications and having to take on all of this additional risk that they didn't account for, right? So now the Department of Insurance is like looking at this twofold, like, holy shit, we have, the Fair Plan's overextended, right? We have carriers leaving. We need to figure something out, okay? So the Fair Plan has agreed to take the other 20% of that market share that the carriers aren't covering. So that's
okay.
And what it'll also do is when these carriers come back in, those people who are on Fair Plans in areas like Mount Helix, somebody had to write a policy with a Fair Plan and difference condition, at the base of Mount Helix over in, La Mesa Rancho, San Diego area. You and I both know that's not what we would consider a high fire risk zone. Right. So when these carriers come back in, we're going to be able to move those types of properties out of the Fair Plan and into a more traditional carrier, which will help alleviate some of that exposure that the Fair Plan currently has. And now, mind you, the Fair Plan is independently owned, operated by insurance carriers. So all the carriers that are admitted in the state of California pay into a fund, and that's what funds the FAIR plan, right? Plus the premiums.
Right.
So it's even the FAIR plan has to go to the Department of Insurance and ask for rate increases. So the FAIR plan can't just turn around and be like, oh, it's a government entity, we're going to charge, twice as much than we were charging. That's going to cover our spread. It doesn't work that way.
Right. So if you live in the hills of Hamul still,
yes,
you're probably going to still have a FAIR plan.
Yeah, Hamul, FAIR plan. Ramona, FAIR plan. Estates, maybe we got something for you.
There you go. Now, you just said something admitted, right?
Yes.
Now, there's admitted insurance carriers and non-admitted or unadmitted.
Yeah, non-admitted.
Not admitted. Explain to our listeners what the difference of that is and what we're dealing with right now versus what will come.
Okay. So the difference between an admitted and non-admitted carrier is an admitted carrier in California is considered somebody who is playing by the rules that the California Department of Insurance has set forth. And those rules being you have to be solvent, right? You can never have more risk on your books than you have essentially money in the bank. You can't just, decide what you want to charge. You have to go through us, right? And so the California Department of Insurance has, put these requirements on carriers to be considered admitted. So that really, in theory, is going to protect the consumer because you're never going to run up in a situation to where, farmers insurance goes belly up and can't, pay to rebuild your house.
Right.
Kind of important.
Kind of, yeah.
Kind of important. So a non-admitted carrier is somebody who still operates and offers insurance in the state of California, but they've pretty much told California, we're going to march to the beat of our own drum. That's cute. We love your rules, but we're still going to do it. Right? So California's like, fine. But there are rules about, in the insurance space on when you can leverage these, non-admitted carriers versus admitted, all of that. That being said, so a non-admitted carrier, I guess, for the consumer, the biggest, I guess, worry or point of concern is, okay, so I'm working with a non-admitted carrier. There is, in theory, a higher probability of them going insolvent than if I'm working with an admitted carrier. And that's where the rub is and the worry is concerned.
So there's a risk for the homeowner
Correct.
in this point more than there would be otherwise.
Yes.
And the rates, what do the rates look like versus unadmitted and admitted?
That's a great question. So they run the gamut. So I've written some policies with unadmitted carriers that were more competitive, looking at it, with a carrier that was doing business in California when I started the quote. And then by the time they were ready to make a decision, the carrier had pulled out. So then we had to go to the non-admitted market and say, okay, well, what are we doing here, right? So there was probably $1,000 less with that non-admitted carrier than it was with the admitted carrier in that instance. But I've seen other instances to where it's, admitted carrier is going to charge me $5,000. A non-admitted carrier is going to charge me $15,000 for the same property for the same coverages. Yeah, really runs the gamut. And at the end of the day, it really depends on the risk, right? And what the underwriters are looking at, what they're looking for, and what they consider within their risk appetite, right?
Okay,
so
right.
if we have something that fits this non-admitted carrier's risk appetite, they're going to take it all day, and they're probably going to take it for a good price because it's like, in their eyes, it's like a sure thing quote,
Right?
Versus something that they're not very familiar with. They're like, I guess we'll take it, but you're going to pay.
So basically, non-admitted is just the wild, wild west.
Yes.
Yeah,
for sure.
Yeah. Okay.
No pun intended, California.
Okay. So that leads us into wrapping this all up. We've got home prices going up. This is Southern California. This is San Diego. Did you see the news? We're like the most expensive place to live in the country now. Whoop, whoop. We did it.
Yeah. Congrats. A little bad honor.
Yeah.
Gold star.
Home prices aren't going to go down here. They might in other places in the country temporarily, but here it's too much of a place to go. People are seeking San Diego too much. So home prices are going up. We all know interest rates are high right now, higher than norm. We're all
8% today.
at least
they dropped down 7.9.
I get you 7.99. How's that
Dude,
sound?
You're a good friend,
It's
Michael.
a sexy 8%.
You're a good friend, my friend.
We got insurance increasing, homeowners insurance, and now HOA dues because of the homeowners insurance. And then, if you remember back at the beginning of all this, HOAs were really a hot mess then too, because we had the whole new Freddie and Fannie guidelines come out that are governing the HOAs and basically making them do their
record keeping,
meeting
minutes. Yeah, do their job.
Do their meeting minutes. Weird. Keep up with their maintenance, to keep a front side of the whole condo from collapsing like Surfside, right? So we've had all these changes in the last couple of years that's just added to the fuel of the fire. What do you think? Is there anything we're missing on the insurance side that we haven't covered today that our listeners need to be on the lookout for? One, is there something you can think of that's more? And then where do you see real estate going, as you are also a realtor, but you're a home property and casualty home insurance as well. Where do you see this going in the next few months for us?
The next few months, I don't see it changing much. This new deal that the Department of Insurance and the carrier struck is supposed to go into effect end of 2024, I believe. So I think we're in for some kind of rough waters in the interim, but like most things, it's going to bring some form of relief, and that relief being options, right? Okay, so even though I believe that just like everything else in California, things are going to continue to become more expensive. Okay, there's just no way around that. And what I'm looking at is going on, between real estate, insurance.
So own your real estate now.
Right. The cost of just everything in California just continues to go up.
Right.
Historically it has, and futuristically, I don't see it changing. Right. So, but the relief is going to come in the form of, like I said, having more options from the insurance standpoint. And when you do have more options, we're going to be able to get back to a place of being able to get those quotes back, same day, few hours, right? If you're working with an agent who knows what they're doing, instead of me having to come back to you and be like, hey, Michael, thanks for sending this over to me. It's a condo. Condo's really hard right now. I got to send this out to 3 or 4 broker networks, see what they come back with, start those. It's going to take me 3 to 5 days, right? When I first started in the business, hey, Paul, I got a condo. Perfect. I got a quote for you, 2 hours.
I was going to say like an hour.
It's almost like I just had it waiting. It's like, yeah, Michael called. Here you go.
Waiting for you to call, Michael. I already got it.
Right. Yeah. Yeah. So right now those days are gone. For the most part, I mean, if you do have one of those homes or properties that fit the carrier's risk appetite, we can still turn them and burn them real quick, quote to bind same day. But until that new deal comes in to play and these carriers start re-entering the marketplace, we're going to be in for some, longer turnaround time, some choppier water. And also, I think it's important to note that, not all independent or captive agencies are built the same. There might be something that you send to me that I might not be able to get to you the same day, but maybe another broker or maybe another captive has carrier access or appetite that they will be able to do. So I think it's important to more than ever to work with multiple people, because at the end of the day, this is about helping clients get into their homes, period, full stop, end of story. There's nothing more important than that. And if I can help facilitate that, I'm all about it. But if I can't, I want to make sure that I still help facilitate in some way, shape, or form these folks get what they need so they can close on that house so they can move into their new home.
I love it. And that's what it is about, is helping educate you guys on the expectations of what's to come, right? And sometimes it's not all rainbows and sunshine.
No, absolutely.
This is our career. We take it very seriously. I've worked with you for 4 years or so now, and we've had a great relationship. But it is working with the right professional in every facet of this transaction, right? From lender to insurance to escrow or whatever. Shout out to my buddies over here at New Venture Escrow for providing the podcast equipment. But it's working with the right professional, right? That truly takes the time to understand, to learn, to educate, and make your experience the best experience possible.
Correct.
Right? Yep. We want to eliminate all the hiccups. This world is hard to navigate the waters of. Yep. That's why you need the trained professionals that are licensed. And not just any licensed person, but one that takes the time to invest in their own career and the outlook and best interest of their clients, right?
Absolutely.
So with that said, that's pretty much the end of our show. Thanks for coming on. Great information.
Of course.
Better Call Paul. Why don't you tell them how to get a hold of you?
Yeah. So Paul Scalone, Dignified Insurance Services. I can be reached at area code 619-246-4806 or paul@paulscalone.com.
Oh, that's awesome. And I'm Michael Seaver, Michael Does Mortgage, and you can reach me at michaeldoesmortgage.com. It's all over my t-shirt. You can find me on Instagram under the same thing, Michael Does Mortgage, and Facebook, Michael Does Mortgage. So that's it, guys. I hope this brought you good value. Thank you.
Thank you.